Is CoreWeave a risky bet right now, or is it a buy, a smart buy? Well, in this video, I'm going to break down the potential risk and how likely it is that those are going to come true, as well as the potential upside, the huge opportunity that lies await, and what the chances of that happening are. And then we'll break down the best trade setup so that we can capitalize on the high volatility and the upside, as well as limit the downside risk at the same time. And we'll show you that live on the trade platform, so be sure and watch all the way to the end. Whether you're a long-term investor or a short-term trader looking at CoreWeave, this breakdown is going to help you understand both the risk and the opportunities and level up your game. Should be a fun video for you here today. One thing I ask, smash that like button down below. It really helps out the channel, and I appreciate it very much. You're certainly welcome to subscribe as well, and we're at an all-time high for subscribers, so thank you very much. And last thing, there's a free options workshop if you're new to options trading down below. You can download that for free, and there's also a paid course if you want to learn options, everything about them. It covers it all. Or if you are an experienced trader and been trading options for a while, it will help you level up your game. All right, before we jump into the risk versus reward breakdown, let's understand why CoreWeave is getting all this attention right now in the market. Well, CoreWeave is a relatively new public company, and like many fresh companies, new listings, it naturally attracts both hype and skepticism. That's because the uncertainty that comes with early stage businesses, limited track records, evolving fundamentals, and of course the lockup period and added volatility. Now, on the flip side, CoreWeave is operating in the AI data center build-out sector, which means the growth potential can be significant if they execute well. And it's also up 126% year to date, and it has a tremendous backlog of contracts. That's why you're seeing interest from a mix of long-term investors hoping for massive upside, as well as traders looking to profit from the short-term moves in the stock. So what we're going to do in this video right now is we're going to frame both directions of the trade. So the downside risk as well as the upside catalyst and potential of CoreWeave. Let's break down the risk. Volatility. First of all, CoreWeave is relatively new to the market. That means limited historical financials and unpredictable trading behavior. With young stocks, even small pieces of news or market rumors can cause sharp price swings both up and down. And secondly, execution risk. CoreWeave's growth story sounds promising, but can management actually deliver? If they miss on revenue expectations, fail to scale, or lose customer adoption, the market can punish the stock hard. And lastly, there's the bigger macro backdrop. If we're in a risk-off environment, small and mid-cap growth stocks like CoreWeave usually get sold off first, regardless of the fundamentals. So how likely are these risks? Well, volatility is pretty much guaranteed. That comes with the territory in a new listing like CoreWeave. And execution risk, I would say it's medium. It really depends on what you think of CoreWeave's leadership. And right now, the numbers year over year are pretty fantastic. Now, the macro risks are always present, but keep in mind, we've got interest rate cuts coming, as well as inflation seems to be pretty much in check. So that bodes well for CoreWeave. Now that we've talked about the risk, let's talk about the upside potential. Now, CoreWeave is positioned in AI and the data center build-out. And if this sector continues to expand, which most think it will, rising demand could lift all players, including CoreWeave. Being in the right growth industry can act like a rising tide and help smaller companies succeed faster than expected. Now, as a relatively new public company, CoreWeave has room to surprise investors. It's right now trading at about half the level that it was earlier. So there's huge upside there. And the numbers are incredible. It's grown 207% year over year with $1.2 billion in revenue. And it's up 86% year over year with backlog at $30.1 billion. So it's growing like crazy. Now, a lot of these younger stocks trade on momentum and narrative as much as fundamentals. So if traders see CoreWeave as a potential growth winner, inflows of speculative capital can drive share prices up quickly. Sometimes far beyond near-term fundamentals. So how likely is it that CoreWeave is going to continue to move up in price over the next year? Well, I'm betting on it, and here's why. Let me know in the comments below whether you think it's going to move up or stay the same or move down. Now, Microsoft is the largest customer, accounting for about 62% of CoreWeave's revenue last year. They use CoreWeave predominantly for AI computing needs, although there is some risk because they do invest heavily in their own AI data center infrastructure as well. Now, OpenAI is another major strategic customer with a contract valued at almost $12 billion. I think it's like $11.9 billion through 2030. This deal could average out to around $2 billion annually if fully utilized, aligning closely with CoreWeave's projected revenue. Together, these two customers alone represent about 80% of their revenue. The remaining approximately 20% of revenue comes from other customers, including research labs, visual effects studios, other tech companies, AI labs, hyperscalers, and enterprises. Some other well-known clients mentioned include Meta and banks like Goldman Sachs and Morgan Stanley. Now let's address an event that happened on August 14th that really affected the price. The stock price of CoreWeave tanked, and here's why. It was the lockup period that expired. Now, that's the window that officially closed, so insiders were finally allowed to sell their shares. And with the stock price so high, they took some profits. So as expected, that created a surge of selling pressure and the stock took a hit. The price dropped sharply as the shares flooded the market. Now, here's the important part. This kind of move isn't unusual at all. Lockup expirations often trigger a wave of selling from early investors that just want liquidity. But history shows once that period passes and investors come back in, the stock can rebound, and the investors tend to focus more on the fundamentals and the growth moving forward. Now, at this point, we've laid out both the risk and the potential upside. Now, in order to take advantage of this, we can utilize an options strategy called the poor man's covered call. So I'm going to break that down and show you right now on the option trading platform. All right, guys, let's talk about the basics of the poor man's covered call and how to place this trade on the option trading platform. This is a tasty trade platform and brokerage. I love this for trading options. There's a link down below and benefits if you go through my link. Extremely intuitive platform for options. So we've got CRWV here in the upper left, and we're on the trade page. And you can see we're having a big update. We're up 8% today in CoreWeave, so pretty good. And you can see that drop after we've been dropping down, and then the move up. And then on the unlocking period, there was a big drop, and now we've kind of settled, and I expect to move back up, and we're getting it today. So again, trade page, let's go out a year. So just to kind of summarize, you've probably heard of the covered call where you own 100 shares of a stock and then you sell a short-term call against it. Well, in this case, we're doing a poor man's covered call, which is basically a lower cost version of the same strategy. So instead of buying the 100 shares outright, which would cost $98 times 100 shares is $9,800. We're going to spend less than 1/5 that cost, basically, maybe a quarter. So it's less risky, and you've got the same or greater upside potential as well. And we can collect monthly income, just like the poor man covered call, by selling that short call against it. So we're going to go out about a year. So we're going to go to 364 days to expiration and open up the August 2026 option chain. Now, calls are on the left, puts are on the right, and we want to buy a call, and we want to be in the money. It's trading at $97 right now. So let's go to the 95 right here for $33.50, and we'll click on that 67 delta, and we'll go to the mid price, $32.10. So that's times 100 shares. That's $3,210. So less than a third. Actually, less than a third the price of buying the 100 shares outright for $9,700. So yeah, not quite a quarter, but a third in this case. Sometimes that's a quarter. And if we go to the curve mode, just like owning the stock, as it goes up in price, you make money as the option increases in price. So if we get back up, if we look at where it was just back in June before that unlock period, it was up at 180. So I expect it to make its way back up there. And if that's the case, then at 180, if we go out here, we would stand to make $5,300 on a 3,200. So a stock double basically by doing that. So let's go back to the table mode. Here's the beauty as well, just like the covered call. We're going to go out to October. I like to go closest to 45 days to expiration for the short call. So we're going to open up the 56 while we've still got this trade on. The October 56 day to expiration, and we're going to sell now a call against it. So instead of selling it against the 100 shares of stock, we're selling it against the LEAPS option. And you can see we can collect right here. If we go to the 34 delta, we can collect $5.40. So that's $540. So the price of this option trade is going to go down by $540. Boom, $26.53. Now, if you can collect $500 every month, that's going to pay off the cost of this trade in less than 6 months. So 5 times 5 is 25. Yeah, it's going to be about 5 months, and you're going to be able to control 100 shares of stock for free. So that's what I love about the poor man's covered call. The way that you manage it once it's on is if there's a down move in the stock and we get to 50% profit on the short call. So at that 550, if we get to 275, then I would close it out and wait for a move back up on the LEAPS. So that's kind of how you manage the poor man's covered call. So I'll need to show that in an upcoming video. But we hit review and send and place the trade. All right, guys. So we touched on the upside catalyst as well as the downside risk and the poor man's covered call, which covers both and limits risk and increases profit potential. So let me know in the comments below. I'd love to hear from you. Are you trading CoreWeave? Do you think it's too risky, or do you see the upside and the potential for the stock moving forward? Download the free options workshop in the link below. There's also a paid course. If you're new to options, it goes through exactly how to trade, different strategies, the best strategies. And if you want to level up your game, if you're a struggling trader or you just want to level up your game, it's a great course, very inexpensively priced, and I guarantee you'll love it. So with that, thanks for watching. If you like this video, watch this next one.